Hi, everybody. It's David Fleming here for the Toronto Realty Group, and welcome to this week's Pick 5. No, I'm just kidding. I'm so used to saying that, I actually thought I was doing Pick 5. No, welcome to my interview with Della. Sciucca. He is my mortgage broker extraordinaire, as I mentioned in Monday's vlog. Yeah, you would have had to been living in a cave on Mars with your eyes closed and your fingers in your ears to not have heard about the mortgage rate increase last week. It was nuts, 100 basis points. And I even said that it never happened in years. Actually, sorry, I said 75 points. It never happened, which makes this even worse. Sorry, can we edit that part out? Anyways, guys, we have a massive increase in mortgage rates over the last few months, and we're now higher than we were at the beginning of the pandemic. So I asked you for your questions. I told you Tony would come on. You guys did an amazing job. There are a ton of questions. So let's go to Tony. Are you there?
Dave, I'm here. Thanks for having me on.
Okay, buddy. We have a lot of questions. The readers have fully come through here. And interesting point for the readers to know. Tony told me the other day that he said he started reading the blog. I said, what do you mean started?
Yeah, I mean, you're writing 3 days a week, so I've got to say there's a lot of content and material to go through, 3 times a week. But I think more importantly is the amount of traction you get with comments and responses is quite amazing. I mean, it seems like you've got a lot of intelligent guys and girls reading this blog and adding their comments. So, do you know any of these guys or girls personally?
No, I don't. And that's the funny thing is that my friends will ask me, they're like, do you know Kyle or Chris or Appraiser? Like, do you know Condo Dweller? Like, do you guys break bread? No, I do not know these people.
Okay.
I guess I won't name names, but there's one person's written a lot of stuff, and a lot of people use fake email addresses, which is fine. I probably would too. But one person posts all the time. I actually emailed she or he and years ago and was like, hey, listen, I just want to say hi and say thanks, for the readership. But yeah, a lot of people would use fake email addresses, but no, I mean you see, right? Who did I name there? Kyle, Chris, Appraiser, Condo Dweller.
Yeah.
There's so many people I can't even name them. Those are kind of the regulars. I'm looking at the comments right now. Kathy, Adam C, Manpreet, Adrian, Trevor, Jason. These are names that maybe JL. I don't know personally, but JL, East Yorker, Vancouver Keith. I don't know. I haven't had it figured out. I think he's a shit disturber, but I'm not sure. You'll like this question. His question says, defend your answer. So I like this guy. RPG, I've seen that name around forever. So I've seen a lot of names on here over the years. I mean, we're, 15, 16, 17 years? I can't even remember right now. But yes, thank you for pointing that out.
Yeah, and it looks like you get tested from time to time on, you're being called out on some of your either content or stats. So, you've got a very intelligent reader base, which keeps you on your toes.
It does. Yeah, I mean, I'm not complaining. And every Christmas or holiday season, I always spend an hour and a half going through the year's comments and figuring out who posted the most, and I put them all in order.
Does anybody send you any Christmas cards?
No, actually. Years ago, someone under the blog named Baby the J bet me. This is going back to I want to say 2008. Bet me on the blog that prices would go down, and he said, I have an old bottle of champagne for you if they don't. And sure enough, this guy dropped off a bottle of 1986 Dom Perignon at the office. Yeah. And I never met him. I never just...
Word.
No, just a guy, and I still have it because I don't drink champagne. Anyways. Okay, so what do you think? Can we roll? Can we go?
Yeah, let's go.
Ready for your answers? People have fast-forwarded already through the preamble. And you look so good, and I look so crappy. I'm dressed for, like a guy in the office.
Yeah, you got the collar. That's good.
I know. I wear what my friend Amy says, oh, you wear a uniform. Yeah, I wear shorts and a polo shirt in the summer. Okay, so let's do this. Sam is going to edit this, so we'll get the comment up here. So first question is from Kathy. Kathy says, what is the spread between variable and fixed? When does it make sense for variable, and when does it make sense for fixed?
Yeah, I mean, so just to answer that question, the spreads right now are trending at about 130 basis points between the fixed and the variable rate. So, variable is sitting at prime minus 0.5%, so roughly 4.2. And today's fixed rates are trending at about, anywhere from 5.19 to 5.39. So you've got about 100 to 130 spread there of basis points to play with. And the second part of that question is, when's it a good time to take a fixed and variable? And I think the traditional answer is there really isn't a good time. I think most importantly, people want to pick a payment and a product that is suitable for them, their risk tolerance, and their budget. A general rule of thumb that I like to use is if you're saving at least 100 basis points or more, I'm an advocate of taking a variable rate, and then conversely the opposite. If you are not saving 1% between those two spreads, it's probably a good indication that you should convert over to a fixed. So that's a kind of rough tool that people can use on the back end, but of course everybody's different, and their risk tolerance is different based on those payments.
So 100 points is the rule of thumb.
Yeah.
So what was not a period, I want to say, in 2020 or 2019 when
2020.
some people's variable rates were higher than 5-year fixed rates?
Yeah, that seldomly happens, but there are periods of time when they're going to overlap. What typically happens is you're not seeing the variable rate higher. You're typically seeing the bank's spreads diminish. So, if a bank was offering prime -1 6 months ago, that spread or that variance has been reduced to prime -15 or prime -20. So the gap is beginning to narrow quite significantly these days, and it's putting a lot of pressure on variable rate borrowers as to whether or not they want to make a decision to convert in today's 5 years, fixed rates.
I'm going to let the cat out of the bag here, guys. Speaking from experience, I remember when I was on a variable, and then Chris came into the office just beating his chest. He's like, Tony just got me a 5-year fixed, and his 5-year fixed was less than my variable.
Yeah.
Playing the interest rate game. Okay, so next question here is from Adam C., who I believe has posted a couple of questions. So Adam C. says, this is a long one, Tony, I'll read it to you.
Sure.
As far as I know, this latest rate increase means that even floating rate mortgages must qualify at rates greater than 5.25%. So it seems like everybody will qualify for less than did prior to the rate hike, and the future rate hikes will further reduce the amount banks are allowed to lend. I know exactly where this is going. Will this not result in some kind of mathematically predictable drop in housing prices since the banks simply aren't allowed to lend as much? I'll let you answer that, and then I'll chime in.
Sure. He is right. The qualifying rate right now to qualify for both fixed and variable rates are quite different. So for example, to qualify on a variable rate, you have to take whatever your current rate is and add 200 basis points. So if your current variable rate is 4.2%, you add 200 basis points, you now have to qualify at the stress test of 6.2%. Previously, that rate or that benchmark rate was 5.25%. So it's gone on almost a percentage point in full on the variable side. And those are kind of rough numbers depending on the variable rate that someone is getting. On the fixed side, similarly, it's very close. If you are inheriting a fixed rate at 5.19, the bank wants to qualify you at 7.19. So what we are seeing is a lot of consumers not being able to qualify on the fixed rates. They are taking a variable rate, and they will at some point in time convert that variable into a fixed. On average, it's probably going to reduce your purchasing power by about 15% with these new stress tests from the previous benchmark rate of 5.25 to 6.25 all the way up to 7.25. So your purchasing power gets diminished quite a bit, and what we're seeing is people who are looking for purchases at 1.5 now have to start looking at 1.2, 1.3. Those numbers have to come down significantly in order to qualify for that property.
Okay, so I figured someone eventually would look at this as just an equation. Ironically, I would say if purchasing power is down 15% and the market is down 15%, right? That is a correlation as far as I'm concerned. If you want to say not necessarily purchasing power, just say what you're approved for, what's affordable, right? The fact that that happens to be the same, is that a coincidence, or do you believe this guy basically, Adam C, wants to say, is it mathematically predictable? If rates go up further, will prices come down lower, right? Or I guess you could say down the line, if rates are cut, will prices go up? Do you think, and I won't hold you to it, do you think there's a mathematically predictable equation here, or sort of we use math to make a prediction, or do you think that this is more of a coincidence at this point?
No, I think there's some sense of a correlation. Typically someone would be able to carry a mortgage of about 5.5 times their gross income at the previous benchmark rate. that number is now being reduced to about 4.5 times your gross income. And as the prime rate and the benchmark rates continue to rise, that carrying capacity begins to diminish quite a bit. Now, if there's some sort of mathematical formula involved in this, I don't think there is. There's some sense of a correlation between when these rates rise, prices will eventually come down. But the problem is we can't arbitrarily say to an agent, hey, by the way, the prime rate went down. You need to now decrease your listing for 13% less or 14% less. So in that respect, listing agents will continue to market prices or homes at the price that they feel is sellable. And I don't think that has a direct impact on the interest rates per se, but there is some sense of correlation because the longer properties sit, the more at some point in time that property is going to, come down in value down the road.
Yeah, okay. So some of the questions here, it's ironic that some of them are playing into each other, some of them are following. The next one, Manpreet asks, not to get too far down the line here, famous last words, but what is your opinion on when quantitative tightening could end? Are we talking 3 to 5 years, or is this just a short-term shock to the system that will be followed by normalizing in the next 12 to 18 months? So I'm no expert in psychology, but I think Manpreet is basically telling us what he hopes is going to happen. So Tony, basically what he's asking you to do is predict the future. When are rates going to come down? And then comment on the idea that we're seeing rates massively increase all at once. Is this just supposed to be a shock and then they normalize?
Yeah, look, I think part of this is, we hear this word inflation quite a bit, and this quantitative tightening is another fancy way of just saying, when are rates going to come down? And the reality is nobody really knows. Nobody has a crystal ball. I think the Bank of Canada's latest announcement with this jumbo 1% hike caught a lot of people off guard, including, many economists. It seems like the main concern for the Bank of Canada now is to tame inflation at all costs. And the message is quite clear, is we will continue to raise rates until things begin to slow down. The prediction, I think, if I had to give an answer, is anywhere from 18 months to 24 months until we start seeing some sort of equilibrium or a reduction in rates, both on the variable side and the fixed side. As you know, bond yields control the fixed markets, and the prime lending rate is driven by the Bank of Canada's benchmark rate. It's really hard to say, but we're seeing bond yields kind of spike a little bit the last couple of days. They came down, back up again. And as you know, Bank of Canada has steadily increased the benchmark rate 225 basis points since the month of March. So in terms of real dollars for variable rate holders, if you have $1 million mortgage, that's a $550 increase in your payment approximately in just one hike. So it's real.
Okay, so let me ask a follow-up question here. Put this up on the screen. David asks, how am I going to phrase this? I'm going to try not to be cynical or get political here. So if you massively increase interest rates, how long do you expect it takes to see a resulting drop in inflation numbers? Is that fair?
Sure.
I don't want to, Richard McNutt accuse me of asking questions and then answering my own questions. What I'm going to say is this. I believe that inflation is going to lag interest rate policy by 3 to 6 months. So now let me say, can you answer my first question? And then tell me if my answer to my own question was accurate.
I think there really isn't a time frame. Obviously the main concern is to get this inflation number down, and the demand has to stop for numbers to come down. And we've printed a lot of money. There's an influx of capital out there, and until people stop spending, this inflation is going to continue to rise. There's obviously a shortage in labor. We have very low employment. There's a lot of factors and criteria that sort of are dictating the cost of inflation. A lot of it is primarily, I think Benjamin Todd made a good point that 60% of the inflation is caused by what's the word? I
watched his. I did a panel with
supply chain disruptions. So 60% of it is disrupted in these supply chains. You have a lot of factors that contribute to this inflation. But the message from Bank of Canada is clear: is in order for rates to come down, the demand has to stop, and we'll see this in every sector, whether it's in travel, whether it's in rebuilding a house or construction or grocery. these numbers have to come down.
Okay, I'm jotting down questions, which I'm going to ask at the end. I want to respect the readers here and go on with their questions. So Adrian asks, when rates are this high, is it true that a variable rate is better than fixed over the long term? He doesn't specify long term, but I don't know.
Yeah, I mean, historically speaking, I think, the variable rates have generally outperformed the fixed rates 85 to 95% of the time, maybe 90% of the time over a 5-year period. So, those who are on variable rates 6 months ago were, sub 2%. Unfortunately, now they're a little bit higher. But, in general, variable rates have typically outperformed the fixed rates for any, 5-year gap.
So for everybody except for me, is what you're saying.
Well, if you didn't switch your variable, you actually may be ahead.
You said 85 to 90%. So I just want to draw people's attention to the fact that I sell real estate for a living, but I found myself in that extreme minority. Okay, Adrian's second question is, or do you think people could still benefit from a fixed rate because rates are going to increase further and stay there? So basically, he's asking you to play the interest rate game.
Sure.
Like, what's today's variable? And what's today's variable, Tony? What's today's 5-year fixed? And then how much does a variable have to go up until it makes sense to have got that fixed? That's what Adrian's asking.
Yeah, look, I mean, I think I've touched on this a little bit earlier, there really isn't a right answer. At the end of the day, you need to select a mortgage payment that is suitable for you and that is affordable for you. At the end of the day, we just don't know where rates are going to be in 3 months, 3 years. And it's hard to predict where these fixed interest rates are going and also these variable rates. The consensus seems to be that they're going to continue to climb slightly more. To what degree, we don't know. But at the end of the day, you need to pick a payment that is comfortable for you and make you sleep a little bit more peacefully at nighttime.
Okay, so if you had a 4.2% variable and you could have taken a 5.19% 5-year fixed, if the variable rate increases 150 basis points, now it's at 5.7, that's when you're saying, damn.
Yeah, I think a good tool is to just kind of figure out at what point you're comfortable no longer taking on a variable rate risk. The bank has to reward a consumer for inheriting a variable rate risk. And that risk is, how much am I going to save in order to continue being on a variable rate where there's the potential for this mortgage to change or my rate to change 8 times a year. Some people say that gap is 1%, some want in 1.25, 150. You need to determine what number you're comfortable with. Again, as a general rule of thumb, if you are no longer saving at least 100 basis points or 1% between your current variable rates and the prevailing fixed rates at the time you're looking to convert, then it's probably a good indication to start converting over.
Okay, good. I feel like we flushed that one out pretty well. Okay, so Trevor asks, it's a good way to start a question. Pretty sure I already know the answer to this, but I think I have to hear somebody say it. So he's being facetious, I think. Why does the Bank of Canada always follow the U.S. Fed? Other than the same reasons. We have to, we always do, we should, our economies are tight, et cetera, et cetera, et cetera. Are there any reasons other than we're doing what we've always done? Much appreciated, David and Tony.
Yeah, I mean, I don't know sort of I can give a Sesame Street answer, and that is, we're US's little baby brother, and I think for the most part we'll do what they do. But more importantly is, our distribution accounts for, I don't know, 60 or 70% of the trades that we do with them. So we want to sort of be on level terms with what they're doing. And I think that's probably the right answer in terms of how we mimic their economies a little bit.
So let me give you a what if scenario. What if their prime was 2.25 and ours was at 1 or 0.75? What happens then if they've raised their rates and we're sitting here?
Yeah, I mean, I think the economies are tied enough where that's probably not going to happen. I think, for the most part, if we see a rate hike in the U.S., you'll probably see it here. And, if you see a rate decline there, we'll probably see it here. A lot of the factors that they have are pretty much on par with us in terms of GDP, employment. Those are the factors that they look at. And trades and services are a big role as well, too. So it's hard to give a specific answer. But I think for the most part, because our economies are so tied, is probably the reason why we generally follow suit or stay close to it.
Okay. So Adam C. responded to this. He said, I think the main reason is because it'll make the Canadian dollar weaker relative to the US dollar. That change in the exchange rate will jack up inflation even more since many of the goods we buy are from the US. I don't think it's due to tradition. Okay. Thank you,
There
Adam
you go.
C.
Adam C.
Okay, so that, with that,
I said Adam C. There you go.
hey, okay. Was there an Adam C? Oh no, okay, again, that is, oh, I'm mixing them up with Andrew C. There's an Andrew later on. Okay. Jason asks, Tony, does the mortgage stress test differ if you take a variable or a fixed, or is this calculation the same? I know you touched on this at the beginning, but maybe just give a direct answer.
Yeah, so the answer is yeah, those two stress tests are independent of one another. So variable rates are whatever your current variable rate is plus 200 basis points. And the fixed is whatever your contract rate is plus 200 basis points. So right now, the stress test qualification is significantly cheaper for someone who's taking a variable rate versus a fixed.
And so you can, here's a question, in the approval process, can you get approved based on one and then switch to the other?
You can do it post funding. So for example, you'll take a variable rate. Once your property closes, you can contact the bank and let them know that you want to change that variable into a fixed. There's no cost to have that done. But you cannot do it before your closing date.
So in theory, you use the variable rate plus 200 points and it increases your affordability. You're saying then you could buy for more and then once you've closed, switch to a fixed.
Sure. I mean, that's one way of circumventing sort of the stress test, but most people will take that risk.
And so have you had people that have done that as a strategy?
Yes, seldomly. I mean, we generally try to do our best to make sure that what people are inheriting in the form of a mortgage is what they can qualify for. Now, there's a little bit of leverage there, but at the end of the day, I always advise my clients, I would be doing a disservice if I'm putting you in a mortgage that you can't afford to make payments on. So ultimately, at the end of the day, you have a little bit of a buffer that you're comfortable pushing, but by no means are we trying to encourage people to buy properties that are significantly outside their cost of living.
Yeah, okay, no, that's fair. So next, Adam C. Again, Jesus. It's like that time when I was in, I want to say grade 6, and Shannon Murray's mother stuffed all of the boxes at the fun fair, and she won every damn prize. And they kept calling her name over and over until finally the principal and the head of the fun fair had a little meeting, and then they disqualified her. And I'm like, first of all, you can't do that. Her mother paid hundreds of dollars for all these tickets, but every single prize, and the winner is Shannon Murray, and she kept winning all of them. So Shannon, meet Adam C. Sorry, Tony, this is what I do in my Pick 5 videos. I have no attention span, undiagnosed ADD, extreme nostalgia, and it just reminded me of that. Okay, Tony's like, no. Okay, so Tony, all jokes aside here, nostalgia, etc. Let's get to Adam C's question. It's third question. They're all good ones, Adam. Thank you. It has only been a week, but are you noticing any different behavior from your clients as a result of the 1% rate hike? So that's the one question I probably would ask you if I got only one question. Thankfully, I'm the one filming this, so I have 30 of them. So I guess, Tony, tell us what last Wednesday was like, and then specifically, are you noticing any different behavior for Adam C's question?
Yeah, I mean, I sort of cringe every time the Bank of Canada has to come out with these rate announcements because I know my phones and emails just blow up. The reality is people are concerned with how quickly these rates are escalating, and for good reason. So it's difficult to manage. You're not only managing a database of clients, but you're also trying to manage a client's emotions. And it's very important to them knowing that they trust you with their mortgage. They trust you with making the right decision or helping them guide them through making proper decisions. And every time there's a rate increase, particularly for variable rate clients, their payments change for the most part. Whether you're with an institution like Scotia that changes their payments, or I think RBC changes them as well. But at the end of the day, people want to be reassured of the fact that where are these rates headed, and when is this going to stop? So they're not fun times, but they're not bad times. I mean, at the end of the day, you're trying to reassure people that over the long run, I think they're going to be fine. But, these rate hikes have been escalating quite quickly. And like I said, 225 basis points since March hasn't been fun.
Guys, wow, this really went over time. A lot of questions. Tony and I are talking a lot. So why don't we do this? We'll break here, and we will answer the second half of the questions on Friday.